All right, guys, welcome back. Please confirm if I am audible and visible to you. Yes, I'm about to tell you the story. Yes. Please confirm if I am audible and visible to you. Are you able to see me? Are you able to hear me properly? Not visible and hear you. Are you able to see me? Muhammad Azam says, I'm not able to hear you. Vidhi Podar says, yes. Shishan says, yes. Om Kakati, yes. Yashika, yes. Muhammad Azam, yes. So, yes. Most of the students are saying a yes, so I will continue with my story now. Yes, sir. All right. We are back, guys. There was some technical glitch. The internet connection got lost, so there was some technical bit, and now we are back with the story of what? Of Provident Fund. We are going to start the story of Provident Fund. All right. I'll erase the things which are given on the screen, and I will show you this particular table. Yes, guys. All right. So we'll start with statutory provident fund, guys. Statutory provident fund is the fund which is incorporated for government employees, central and state government employees. This fund is there for state and central government employees. So this is the statutory provident fund which is there for government employees and central and state government employees. So guys, in this particular fund, we will respect your emotions. Your emotions are that, sir, anything which is given at the end of the retirement period, anything which is given which is related to retirement, which is related to once in a lifetime kind of an event, sir, so that should be exempt from tax. We'll respect your emotions, guys. We know in the starting of this particular topic, retirement benefits, you had told me, said we have an emotional connect with this particular part of the salary. Yes, because it is given once in a lifetime. Since it's given once in a lifetime, there has to be some soft corner for this particular thing. So yes, employer's contribution is not taxable. Employer's contribution is not taxable. We will give it free of tax to you. And the lump sum withdrawal, please see, lump sum withdrawal, which means after when you get your retirement. So suppose if you had started working in 2010 and you had worked till 2070, you had worked for 60 years, we will exempt your employer's contribution which is made in every year. We will also exempt the lump sum withdrawal amount that you receive after your retirement. We will also exempt that amount. So both of these things are exempt from tax. The employer's contribution is also exempt from tax, and the lump sum withdrawal is also exempt from tax. Both of these emoluments will be exempt from tax. There will be no tax that will be levied on both of these elements, the employer's contribution as well as the lump sum withdrawal. We respect your emotions. Your emotion are saying that, sir, retirement benefits which are given once in a lifetime should be exempted, sir. They are not salary. They are not a reward for working. They are actually the funds or the savings which we will use in our old age, sir. Please exempt it from tax. We have exempted it from tax. Now the question comes for employees contribution. Guys, employees contribution forms a part of the salary. I had given you an example that salary is of 50,000 rupees. Salary 50,000 per month is withdrawn by an employee. Now this 50,000 rupees is taxable as salary. Guys, this employee's contribution is a part of salary, so it will always be taxable. It will always be taxable because it forms part of the salary. But we will give you certain benefit. We will give you a deduction for it under section 80C. So when you calculate your gross total income, so this is your salary. Okay, now there must be certain allowances, there must be certain perquisites which you'll add over here. Then there will be employer's contribution to PF, which will be nil because it is a government regulated fund. The total salary is 50,000 rupees, and guys, we will allow a deduction of 3,000 rupees from this 50,000 under section 80C. So indirectly we are giving you a benefit of employees contribution. It is not free from tax, but indirectly we are giving a benefit of employees contribution. Also, employees contribution is an essential part of the salary itself. So that is the first part, which is statutory provident fund. Now the question arises, sir, is interest also accrued to the fund which is created? Because guys, I've already told you that fund is created like an FD, like a fixed deposit. So we receive interest on fixed deposit. So would interest also be accrued on these funds? Answer is yes, interest will be accrued on these funds. So for 60 years, your money will not go waste. For 60 years, your money will earn interest for you, and that interest will also be redeemed to you at the end of the 2070, which is your retirement year. At the end of that year, that will be redeemed to you. Again, not taxable at all. Again, not taxable at all. So this was the story of statutory provident fund. We respected your emotions, which you had told in the start of the class. Next, recognized provident fund. I've already told you, this is for private employees. This is for private employees. Now the question is, sir, just like for government employees, the provident fund was exempted. So please exempt this fund also. What is the need of taxing this fund also? Sir, our emotions should be respected, right? So please respect our emotions. Why don't you respect our emotions in this respect also, sir? So please exempt recognized provident fund also from tax. Guys, government servants are regulated by strict norms, and there cannot be any tax evasion or deliberate tax evasion as far as government employees are concerned. There is a very less chance that for tax evasion certain steps are being taken by government employees, for the government employees. But in case of private employees, there is a riskiness, there is a problem is that, suppose if I say that entire employer's contribution is exempt from tax, suppose if I say that for private employees, okay, suppose if I say that entire contribution is exempt from tax, there is a possibility that the employer starts giving the salary also as part of employer's contribution. I'll give you an example. Suppose someone's salary is 50,000 and someone's employer's contribution to PF is 3,000 rupees. Now, since 3,000 rupees is exempt from tax, there's a possibility that employer and employee shakes hand with each other and they come to a conclusion that, okay, listen, employee, I will give you 30,000 as employer's contribution, 27,000 extra, and I will reduce your salary amount to that extent so that you save upon tax. So that you save upon tax. This is a deliberate measure, a structuring or strategy structuring, which can happen in case of private employees. So why can't it happen in case of government employees? Because, guys, government employees are regulated by bylaws of government. Government will never do such a step to evade tax. Government itself will never do it. Government employers will not do it. So it is possible in case of recognized provident fund. Yes, entire salary can be given as salary if entire retirement benefit, entire provident fund can be named as salary if it is free from tax, if it is exempted. And therefore, guys, there is a restriction on exemption of recognized provident fund. Whatever recognized provident fund is being given by employer to employee, only 12% is exempt, rest is taxable. Only 12% is exempt, rest is taxable. So out of 50,000, only if you give a portion of 50,000 in provident fund, which is 12% of 50,000, only then that will be exempt. If you contribute, say, 15% to recognize provident fund, then, guys, 3% will be taxable in your hands. So again, exemption is granted, but to the extent of 12% only. We have restricted the exemption amount. We will not give an unlimited exemption amount. If we give an unlimited exemption amount, then private employee will make sure that instead of disbursing salary, it disburses that entire amount by way of provident fund. This will happen. Therefore, this exemption happens. All right. Muhammad Azam says, in statutory provident fund, only employees' contribution is taxable. No. Yes, Azam, employees' contribution is taxable, but again, a benefit is given. So it is again not taxable. Okay. Because of the benefit of 80C, it is not taxable. Initially, it will be taxable. Going forward, it will not be taxable in case of employee statutory provident fund. But yes, employer's contribution will not be taxable at the initial stage itself. You are right. Private employees would avoid tax. Very good, Kirti Batra. All right. So the limit is 12%. If you contribute to up to 12% to the recognized provident fund, tax free. Then again, eligible for deduction, 80C deduction will be eligible for employees' contribution. Of course, at the first place, it will be taxable. Then deduction will be allowed. Again, interest will be exempted to the extent of 9.5%. Only 9.5% per annum interest will be exempt. Over and above that particular interest will be taxable in case of recognized provident fund. then lump sum withdrawal will not be taxable. Why it will not be taxable? Because guys, we have already taxed the initial part. When we have already taxed the initial part in the initial contribution, I will not tax lump sum withdrawal. Whenever lump sum withdrawal happens, I will not tax it because it will amount to double taxation. Therefore, lump sum withdrawal is not taxable in case of recognized provident fund. Now we come on to unrecognized provident fund. So if your employer is contributing to unrecognized provident fund, URPF. If the employer is contributing to URPF, then please tell me whether this URPF belongs to employee or employer. Please tell me whether URPF belongs to employee or employer. Is there any risk in URPF? I had already told you there's a risk in URPF. What is that risk? My first question is whether this URPF belongs to employee or it belongs to employer. Whether this money which is there in URPF, whether this money belongs to employer or employee, that is my question to all of you. Whether this money belongs to employer or employee. मतलब 20% पर होती तो वो 12% टैक्स फ्री होंगी. ऋषिका, perfect. Rishika, perfect answer. Zainab says employee. Okay. Who else? URPF belongs to whom? Employee or employer? Kirti says employee. Rani says employee. Shreya says employee. Okay. Please give your answer. Unrecognized provident fund belongs to employer or employee? Pankaj says employee. Manav says employee. Okay. Deepika says employee. Guys, the answer is URPF belongs to the employer, because at any given point in time, the employer will withdraw money from URPF and use for its own purposes, because URPF is not regularized by CIT, Commissioner of Income Tax. URPF is not regularized by CIT, Commissioner of Income Tax. Therefore, at any point in time, money can be withdrawn from URPF and it will be given to the employer. Therefore, URPF doesn't belong to employees unless and until employee receives the money. Till the time employee receives the money, till the time employee gets the money, this money is not employee's money. This is employer's money. Do you agree or not? Do you agree or not? Whole graphite and paper says whole RPF contribution amount is eligible for deduction, or leaving exempted amount, taxable amount is eligible for deduction. So only the amount over and above the exempted amount is taxable. Okay, so 12%, up to 12% is exempt, beyond 12% is taxable in case of RPF. Now we are on URPF. Please tell me whether this money of URPF belongs to employee or employer. Answer is employer. My next question is, when will it become money of employee? When will it become money of employee? Please write in the chat box. When will it become money of employee? Please write in the chat box. I want the answer in the chat box. Please write in the chat box. When will it become money of the employee? When will it become money of the employee, this URPF? Currently, it is money of the employer. Employer can withdraw money anytime from this URPF. When will it become the money of the employee? When employee will receive it. Zainab Fayaz, Zainab, Nidhi Kirar, Megha Tomar, Shreya Guneet, Nandini, Kirti Batra. Perfect. So now the question is, should this be taxable when it is being contributed? Answer is no, it is not taxable when it is being contributed, because it is not employee's money. This is employer's money. When this is employer's money, it should not be taxable in hands of the employee. So not taxable when contribution is being made. Not eligible for deduction under 80C, because this is not employee's money, this is employer's money. So it will not be eligible for 80C deduction as well. Not eligible for 80C deduction as well. Whether interest will be taxable? No, not taxable. Why? Because this particular interest doesn't belong to employee. So when it will be taxed? It will be taxed when it is lump sum withdrawn at this point in time. So obviously there are some certain conditions which are there for its taxability, but I'm telling you generally, when will it be taxable? It will be taxable when it is lump sum withdrawn by the employee. When employee actually receives it, then it will be taxable in hands of the employees. Before that, it won't be taxable in hands of the employees. So that is the reason why URPF is treated in this particular way. And last is public provident fund. Public provident fund doesn't belong to employer-employee relationship. It is for general public as well. So not applicable. Employer's contribution doesn't happen, so it is not applicable. It is eligible for deduction under section 80C only. Okay. Interest is again not taxable. Lump sum withdrawn is also not taxable. Public provident fund is again a government regulated fund, so and the entire amount is not taxable. 80C reduction is given for the employee's contribution. Actually, not employees, but the person's assessee's contribution in this particular case. This is eligible for 80C deduction. So yes, these were the logics behind the various provident funds and the way to remember them. Okay, if you remember these provident funds and their tax treatment using the techniques that I've given you, like what is URPF, whether it's employees' money or not, if you learn it using these techniques, then you'll be able to learn it quite well. Okay, sir, got it. Now we come on to the next retirement benefit, guys. Next retirement benefit is gratuity. Gratuity is received at the end of the period. At the end of the retirement period, gratuity is received. It's again a lump sum consideration which is received by the employees from their employers. Received at the time of continuation of service. If it is received when the service is continuing. So guys, you cannot catch hold of employer and say you cannot pay gratuity till the time the employee retires. You cannot do that. It is employer's wish. It can pay gratuity, leave encashment, or any kind of retirement benefit during the continuation of service as well. It is employer's wish. Okay. The thing that Income Tax Act can do, it can make the gratuity taxable. So whatever gratuity is received at the time of continuation of service, when the service is being continued, at that time, whatever gratuity is being received, it is taxable in hands of all the employees. We will tax it because that gratuity is actually not gratuity. Actually, it is salary. Actually, it's not gratuity. If you receive it during continuation of service, it is not salary. It is not gratuity, it is salary. Because a unique feature of gratuity is that it is received after retirement. So this is what? Received during continuation of service. This is what? This is actually salary. Second, received after death of the employee. When the employee dies, at that point in time, if gratuity is received before retirement date, then not taxable in hands of legal heir. It will be received by the legal heir of that particular employee, like his wife or son or daughter or something like that. Then it is not taxable in hands of the legal heir. Received at the termination of service. Now this is very, very important. When the service is being terminated, when you are your job is being discontinued, either when you get retired or before that, if the gratuity is paid on termination of service at that point in time. In case of government employees, not taxable in hands of employees. In case of government employee, the gratuity is not taxable, whichever is received at the time of termination of service. But in case of non-government employee, we have to refer to the next slide. Let's see what is the next slide. So yes, this is the next slide which demonstrate the taxability in case of non-government employees. Taxability in case of non-government employees. So guys, in case of non-government employee, which is the private employees, gratuity is received. There are two parts to it: covered under POGA or not covered under POGA. The gratuity, the employer can be either covered under POGA or it can not be covered under POGA. So both the options are there, whether it is covered under POGA. What is POGA? POGA means Payment of Gratuity Act. There's a formal act which is being created, and that particular act has given certain guidelines on what quantity of gratuity should be paid. Okay, so either it is covered under POGA, the company is covered under POGA, or it is not covered under POGA. If it is covered under POGA, then the exemption will be minimum of the following. So whatever gratuity is given by the employer to the employee, we cannot control that. We cannot tell the employer, hey, employer, look, only give this much gratuity. We cannot control that. So what we can control is exemption amount. We will not give the entire amount as exemption. So guys, for government employees, we have given entire amount as exemption, as we are sure that government employee will not misutilize the privileges for tax benefit. Government employers will not do that, but non-government employers can do that. Therefore, for non-government employers, we have restricted the exemption to the minimum of the following. What are the three limits? Three limits are actual gratuity which is received, or 25 lakh rupees in total, or this is the formula which is given in the Gratuity Act, which is 15/26 salary per month multiplied by completed year of service. So half month's salary multiplied by completed year of service. 15/26 into salary per month. That is the amount which is exempt. Okay, this is the amount of exemption. So guys, this particular formula is again given by Poga has only propounded this particular formula. 15 by 26 salary per month multiplied by completed year of service. Whatever year of services have been completed, we'll multiply 15 by 26 of salary in those months, then we will get the exemption amount. So lower of the three, 1, 2, 3, lower of the three will be now the exemption amount. Now the question is, what will be exempt in case we are not covered under Poga? Guys, in case we are not covered under Poga, then Income Tax Act has itself computed the same limits which are there over here also. Actual gratuity received 25 lakh rupees, okay, and half of average salary multiplied by completed year of service. Now, what has Income Tax done over here? Let me tell you. This is also an interesting story, guys. Income Tax Act has copied the formula which was given in Poga as it is. Income Tax Act has copied the formula which is given in Poga as it is, and that particular formula has been tweaked a little bit, has been changed a little bit by the Income Tax Act. That particular formula has been changed by the Income Tax Act a little bit. So how has Income Tax Act changed the formula? Guys, the Income Tax Act has changed the formula using certain things like 15 by 26 was given earlier. Now the thing which is given is half instead of 15 by 26. It's given half instead of 15 by 26. Almost means the same. Almost means the same. It is just that this computation will be a slightly different computation, 15 by 26, and this computation will be slightly different. Both means the same, almost half or 15 by 26. This is also half a month. This is also half a month. Now, one intelligent thing which the Income Tax Act has done is, okay, yes guys, absolutely, this is actually, this is 20 lakhs. This is not 25 lakhs. This is 20 lakhs. Okay. Now, one very interesting thing which the Income Tax Act has done is, it has, instead of using salary per month, it has taken average salary. Average salary means average salary of past few years average salary is given. Past 10 months average salary is taken, so that the last drawn average salary might be a very high amount, because last drawn average salary means it will be a very high amount. So instead of using last drawn salary per month, it has used average salary per month. Plus, guys, one more change in salary. In case of salary, the dearness allowance is which forms part of retirement benefit, and commission is which forms percentage of total turnover. That is the salary definition which is there in the Income Tax Act, right? However, in case of Poga, there is no concept of DA which forms part of retirement benefit. So even if it doesn't form part of retirement benefit, then also it will be included in case of when the case is covered under Poga. But when the case is not covered under Poga, in this particular case, guys, the salary which is to be computed is DA which forms part of retirement benefit, and commission which is percentage of turnover. So slight difference between the formula, but intention is the same. Since Income Tax Act has created this formula, it has created this formula according to its own rules, according to its own norms. But the formula which is given in Poga, that formula is derived from Poga itself. That is the difference between the exemption amount. Okay, sir, got it? So guys, this is the difference. All right. So leave encashment, this particular chart is already with you guys. I am skipping this leave encashment because leave salary encashment is a very, very simple topic. It is not worth giving time to it. Yes, this is a very important topic, guys. Pension, okay? So leave salary encashment, I hope you will do it yourself. The PPT is already in the WhatsApp group. Please do it. And if you face any problem, then please let me know. All right. बिल्कुल ऋषिका, absolutely. Sundays का relief मिला है, बिल्कुल. Ishika is right. All right. So pension, now pension is the periodical payment which will be received by any person. That periodical payment will be divided into two parts: commuted pension or uncommuted pension. Okay, commuted means when the pension of the future years or the future months are accumulated together. That is known as commuted pension received in lump sum. Post retirement when the pension is received, when the pension is received in a lump sum basis. So sometimes what employees tell their employers is, we don't want a monthly payout, you just accumulate the monthly payout and give it to us in total. Okay, please estimate the date up till which we will leave, approximately within which we will live. Till that date you accumulate all the pension amount and give us in lump sum on our retirement. This is known as commuted pension. What is uncommuted pension? Uncommuted pension means received periodically. It will be received monthly only till the time you are alive. So it is received periodically over a period of time post retirement. So in case of uncommuted pension, it is fully taxable for all the employees. It is fully taxable for all the employees. If it is given in a periodical manner, it will be taxable for all the employees. In case of commuted pension, we have divided into two parts: government employees and other employees. In case of government employees, it is fully exempt. In case of government employees, it is fully exempt. Yes, Rishika, absolutely. Rishika is absolutely right. Rishika says that, sir, it's a little bit confusing, that meaning of salary. Every benefit gives a different meaning of salary. That's true, Rishika. Every salary will give a different meaning of salary. But the point is, Rishika, that, there are only 2 or 3 definitions of salary, not more than that, okay? So there are not many definitions of salary. There are not 10 or 15 definitions of salary. There are only 2 and 3. HRA has a definition of salary. Rent-free accommodation has a definition of salary. Retirement benefit has a definition of salary which is same as what is given in HRA. So they are very similar. So they are not very much. It will be easily be remembered by you. So please provide PDF notes which you have been shown in Provident Fund. Yes, Srividya, I will provide it in the WhatsApp group. All right, pension, commuted, non-commuted. Uncommuted will be fully taxable. Commuted will be fully taxable in hands of government employees. But in case of private employees, the commuted pension received with gratuity. If you receive commuted pension with gratuity, then 1/3 of total pension will be exempt. And if you receive the commuted pension without gratuity, then half of total pension will be exempt. So in this case, 1/3 of total pension will be exempt if you are receiving pension with gratuity. And if you are receiving pension without gratuity, then half will be exempt. Now, how to remember this 1/3 and half? Okay, I'll give you a simple logic by which you can remember 1/3 or half. Okay, when you are giving commuted pension with gratuity, then guys, you have already taken benefit under gratuity. The exemption benefit of 20 lakhs which is there in the gratuity, you have already taken that benefit, right? Now we are going to give you a lesser benefit. We are not going to give you half as exemption. We are giving you 1/3 as exemption. This is the logic why the exemption is less in case pension is received with gratuity. If gratuity is also being given, pension is also being given, you have already taken benefit of gratuity. Now pension benefit will be given at a lower amount, which is 1/3 of pension. But if you have not received gratuity, if you have not received gratuity and you have received only commuted pension, then guys, your exemption will be to the extent of half of total pension. Half of total pension will be exempt in your case. That is the difference between these two kinds of pension and their taxability. So just a way to remember it. Okay, just a way to remember it. That's it. Okay, sir. So this was pension chart. It is very, very important to understand this particular pension chart. Retrenchment benefit. Annuity is very simple, guys. I don't want to spend time on annuity. Annuity is very simple. There are only 2 aspects to it. One is taxable as salary, other is taxable as income from other sources. All right, now we come on to the last part of our salary chapter, and here I will like to end the salary chapter. Guys, salary chapter has certain deductions, and we are going to see those deductions which are there in the salary chapter. Yes, sir. Okay. So these are the deductions to salary chapter. What will be allowed as a deduction? So guys, there are 2-3 deductions which are allowed in the salary chapter. Number 1 is standard deduction. Standard deduction is a deduction which is not given on the basis of expenditure that you do, on the basis of any kind of bills that you produce before Government of India. Standard deduction is given at a flat rate of 50,000 subject to salary. Salary should not be less than 50,000. 50,000 is a standard deduction which is given to every salaried employee. Second is entertainment allowance. If you have been given an entertainment allowance, then a deduction for that entertainment allowance will be given to you. Yes, entertainment allowance will first be added to your salary because it is a fully taxable allowance. So entertainment allowance will first be added to your salary. Then a deduction is given only to government employees. It is eligible only to government employees. Actual allowance or rupees 5,000 or 20% of basic salary, minimum of these two will be exempt only in case of government employees and not in case of any other employee. Then the next deduction is with respect to employment tax or professional tax, guys, in certain states there is some professional tax, there is an employment tax which is there in certain states, not in all states of the country, but in certain states. If it is paid by employee, if the employee pays professional tax, then it is allowed as a deduction on cash basis whenever the professional tax is paid to that particular state. For example, if the professional tax is paid to state of Maharashtra, then the deduction will be allowed in the year when this professional tax is actually paid to the state of Maharashtra. Then if the employer gives this particular professional tax on behalf of the employee, if he gives this professional tax to the state of Maharashtra, then it is added to salary as a taxable perquisite and then allowed as a deduction on cash basis. It is first added as a salary part and then allowed as a deduction whenever the employer pays it further, then it is allowed as a deduction. So no profit or no loss to the employee. Again, in this case, no profit or no loss to the employee. In this case also, no profit, no loss to the employee. Employee remains immune to it. Employee will get full deduction of this particular professional tax which he pays. Okay, guys, so that's all for this particular chapter, guys. This is the salary chapter for all of you. And yes, by far one of the largest, one of the lengthiest chapters of your syllabus, which comes to an end today. And yes, now we'll be starting the chapter on house property. Next next class, which is on Thursday 9 a.m., we'll be discussing salary chapter. We'll be discussing house property chapter. And yes, guys, on Sunday also there'll be test of house property chapter. So I'll be disclosing the details on the WhatsApp group. If you want to join the WhatsApp group, then guys, please note this number: 9643929913 is the number where you can join the WhatsApp group as. And before you end the session, please hit a like button, guys. Please press that like button so that I am motivated, and yes, I am geared up to continue with the future classes as well. So that is the thing which is there. Perfect, guys. All right, that's all for this particular session. We'll be meeting in a subsequent session with more such concepts, which more such practical aspects of our entire DT chapter. And yes, date sheet is out. 27th of June, date sheet is out, guys. Let's gear up. Day and night, we need to study. Nothing can digress us from our goal of achieving CMA Intermediate in June 2022 examination. So till we meet next, all the very best and happy studying. Bye bye.